Hi everyone, my name is Edwin Lim. In this video, we will cover topic 2, recording business transactions. Just an overview for today's topic. In this topic, we will first look at the accounting cycle. And what is the starting point for the accounting cycle? Identifying business transactions. To identify business transactions, we will refer to source documents including receipts, invoices, and remittance advices. And how about the ending point for the accounting cycle? Financial statements will be the output or ending point of the accounting cycle. We prepare key financial statements, including the income statement, the balance sheet, and the cash flow statement to communicate useful information to various users for their decision making. Then, we focus a little bit more on recording business transactions. To record business transactions, we rely on the concepts of debit and credit, which are in turn based on accounting equation, and we look at accounting equation in the previous topic. When we record business transactions, we first record them at journals, we then post them to individual ledger account, then we summarize the closing balance of each ledger account to prepare a trial balance. So make sure that you go through the learning objectives yourself. As mentioned in the previous topic, learning objectives are very important because they reflect what is going to be in the exam. Now, before we go through today's topic, we should discuss your revision question 1 or case study 1. So let's assume that you have actually attempted this question. And what is this question or case about? It is about Academies Australasia. Academies Australasia is a listed company. Its headquarters is in New South Wales. And what is the problem here? The company is required by the regulator, the ASIC, to adjust its reported revenue. The company received money from students and recognized the money immediately as revenue. The regulator is not happy with this treatment. And why is the regulator unhappy about the accounting treatment? So we need to discuss it using the conceptual framework. We need to debate whether there is any income or revenue here. Now, before we discuss, we should look at the question carefully. What is the timing for this question? It is at the time of student enrollment. Have students gone through the classes when they enroll? No. So let's apply the definition of income and discuss each of them. Is there any increase in economic benefits? Yes, there are inflows to the entity when the company receives money from students or clients. Is there any increase in assets or decrease in liabilities leading to a net increase in equity? The answer is no. Why? Let's have a closer look. Is there any increase in asset? Yes, because cash is collected upon student enrollment. Is there any decrease in liability? No, but there is an increase in liability instead because tuition services have not been provided. The company has a present obligation to provide tuition services over the next few months. Is there any net increase in equity? No. There is no impact on equity in this case because if we apply accounting equation, equity equals to asset minus liability. At the time of student enrollment, asset and liability increase by the same amount. So they offset each other. There is no impact on equity. Is it a contribution from owners? No. Money is collected from customers, not from the shareholders. So what happens here? Because it fills the revenue definition or the income definition, we do not need to discuss the recognition criteria. And just as a quick revision, what are the two recognition criteria we covered in the last topic? Probable occurrence and reliable measurement. Can these be recorded as an income or revenue? No. In fact, the company will have to record this as unearned revenue, which is a form of liability. And we will look at unearned revenue in closer detail in the next topic. So when can the company record revenue? Based on accrual accounting and the definition of income or revenue, revenue can only be recognized when they are earned. So they will only be recognized over the period when the services are provided. Alright, let's go through today's topic. The accounting cycle contains three important parts. The first part is to identify transactions. We need to see if there is any past event or past transaction. So how do we prove that there is a past transaction? Based on source documents. Source documents give us accounting data which we call inputs. We will look at different types of source documents later. And why is having source documents important? Which qualitative characteristics of information can you relate to? Here we can relate to faithful representation and verifiability. Before we move on, I have a question here. Why is it important to identify a past event or past transaction? Link this to the definition of asset and liability. For both assets and liabilities, we need to show that there is a past event or past transaction. If there is no past event or past transaction, there will be no asset and liability. And if there is no asset and liability, there is no equity, and there will be no income and expense as well. Because the definition of income and expense depend on whether they are assets, liabilities, and equity, the identification of past event and past transactions are important. The second part of the accounting cycle is to measure and record transactions. We need to analyze what accounting elements are involved in this transaction, and we apply bookkeeping concepts of debit and credit for various entries. When we process these transactions, we record them in accounting books such as journals and ledgers. Finally, we need to communicate financial information to external users for useful information, for useful decision making. We will summarize our accounts by preparing key financial statements such as the balance sheet, the income statement, and the cash flow statement, which represent the output of the accounting cycle. This flowchart presents 8 specific steps in the accounting cycle. The first step is to obtain inputs by collecting source documents before we can recognize the transactions. The subsequent steps deal with processing. The second step is to journalize transactions, and the third step is to post journal entries we did in the second step to individual ledger accounts. We will then prepare a trial balance. So the trial balance is to check whether our total debit amount equals to our total credit amount. We will cover the first 4 steps in today's topic. The subsequent 4 steps, which involve adjusting entries, closing entries, post-closing trial balance, and preparation of financial statements, will be covered in the next topic. So let's look at the first step, source documents, as a starting point which provides inputs to the accounting system. Source documents are written evidence for every transaction. They show the details for the transactions. For example, who are the transacting parties? Who is our customer? Who is our supplier? What is the date? And what is the amount? This information is important to support accounting entries, which will be used to resolve any disputes, because everything is written in black and white. Source documents are also for auditing purposes. Auditors will randomly check whether the documents are correctly accounted. If they are not, then the auditors will question and challenge managers. Some examples for source documents include sales invoice. Sales invoice records sales of goods and services provided to clients. We also have remittance advice. And what is remittance advice? It is a letter sent by a customer to a supplier to inform the supplier that their invoice has been paid. We also have supplier's invoice. This is the invoice sent by suppliers for purchase of goods and services. We have check butts, which shows payments made by check. We also have cash register tapes, which record cash received for cash sales. Alright, student task. What business documents will you need to collect to verify the following transactions? Now, the documents can be more than one. Let's assume that you have attempted the questions. What do we use to verify a credit sale? We can rely on sales invoice. What do we use to verify the payment to creditor or to your suppliers? We can look at check but. We can also look at EFT, payment. And what is EFT? Electronic funds transfer. And what do we use to verify items like stationery expenses? Because stationery expenses are usually of small amount, we can rely on petty cash voucher or receipts. And what do we use to verify the cash received from a debtor? The cash received from a debtor means the cash received from a customer. So we can look at remittance advice or check. And what do we use to verify the purchase of goods on credit? We can rely on supplier's invoice or delivery dockets and notes. After you have collected the source documents, you can now move to the step 2 to record the transactions. We can perform a transaction analysis. Transaction analysis is based on the accounting equation. Assets equals to liabilities plus owner's equity. And we must ensure that there are twofold effects of transactions. Twofold effects mean each transaction has two effects which balance each other. So let's go through some examples. First, when owners contribute cash to the business, cash at bank, which is an asset, will increase. And we will also treat this as a capital contribution, which is an equity account. So in this case, asset and owner's equity increase by the same amount, so the accounting equation is balanced. Next, when we purchase an equipment with cash, equipment as an asset increases, but cash as another form of asset decreases. So one asset increase, another asset decrease by the same amount, so the accounting equation is still balanced. Next, how about when we purchase a motor vehicle on credit? In this case, motor vehicle, which is a form of asset, increases, while accounts payable, which is a form of liability, decreases by the same amount. So the accounting equation is balanced. When we pay creditors or suppliers, our cash asset declines, but our accounts payable, which is a form of liability, also declines by the same amount. So the accounting equation is balanced. When we receive money from debtors or your customers, our cash asset increase, but our accounts receivable, which is another form of asset, decreases, again by the same amount. So the accounting equation is balanced. In reality, we do not really perform transaction analysis. We can go to step 2B directly and do the journal entries. To perform the journal entries, we must understand the double entry system. And here we go with the concept of debit and credit. For every debit, there must be a corresponding credit to hold the accounting equation balance. And we will discuss more about debits and credits later. After we prepare journal entries, we need to post the entry to the general ledger account in step 3. And why is step 3 important? Because the value for every item that you see on the financial statements comes from these individual ledger accounts. We can have all sorts of ledger accounts such as cash at bank, motor vehicle, sales, and so on. Similarly, every ledger account has two sides, and the following shows the T format of a ledger account. And what does debit and credit mean? Debit means left-hand side. Credit means right-hand side. Does debit necessarily mean increase? No. Does credit necessarily mean decrease? No. Debit and credit only refer to left-hand side versus right-hand side. When we perform the double entry, there must always be at least one debit and one credit. So this is to meet the principle of duality. The dollar amount of debit must equal to the dollar amount of credit, so the accounting equation is balanced. For example, when a customer pays for credit sale, debit cash at bank to show an increase in asset, credit accounts receivable, which is a decline of another asset. Here we have at least one debit and one credit, so accounting equation holds. Recall from your accounting equation, asset equal to liabilities plus owner's equity. Here you notice that assets are on the left-hand side. So to increase asset, we will debit. The normal balance for assets will also be a debit. On the other hand, because liabilities and owner's equities are at the right-hand side, to increase them, we will credit. And the normal balances for liabilities and equities are therefore a credit. And we can further expand the accounting equation because we know that owner's equity equals to capital plus opening retained profit plus revenue minus expense minus dividend. Because we minus expense and dividend at the right hand side, we can actually shift them to the left hand side of the equation to join asset, so they become plus. So in this case, expense, asset, and dividend will be at the left hand side. So the normal balance is actually a debit balance. To increase them, we debit, and to decrease them, we credit. On the other hand, if you look at liability, capital, retained profit, and revenue or income, they are at the right hand side of the equation. So they have a normal credit balance. To increase them, we will credit. To decrease them, we will debit. So this table summarizes what we have gone through just now. The natural balance indicates the normal balance. So for assets and for expenses, the normal balance are the same. Debit. So they will have normal debit balance. To increase, we will debit them, and to decrease, we will credit them. On the other hand, for liabilities, owner's equity, and revenue, they have normal credit balance. So to increase them, we will credit, and to decrease them, we will debit. Alright, student task. So let's assume that you have attempted this question. So let's go through each item one by one. Inventory is an asset, debit. Revenue received in advance or unearned revenue is a liability, so credit. This is reflected in the case study that we went through at the beginning of the topic. So the company has present obligation to provide goods and services in the next few months because they have received the money from customers. Cash at bank, asset, therefore debit. Accounts payable is a liability, so credit. Retained profit is equity, so credit. Cost of goods sold is a form of expense, debit. Equipment is a form of asset, debit. Accumulated depreciation. Now accumulated depreciation shows how much depreciation has been recorded so far. It is a negative asset account or a contra asset account. If asset has a normal debit balance, a contra asset or a negative asset account will have a normal credit balance. Depreciation expense is a form of expense, so we debit. Dividends. Now dividends is a distribution of equity. It will reduce equity. And we know that for equity, it will have a credit balance. If you have to reduce the equity, this will have a normal debit balance. So dividends will have a normal debit balance because it is a distribution of equity. Sales revenue is income, so credit. Prepayments. Prepayments means you have paid in advance and you have right to receive the goods and services over the next few months. So this is an asset, debit. What about general reserve? General reserve means you allocate some of the retained profits to an account, and this amount is safe and will be used to offset any potential future losses. General reserve is a type of equity, so credit balance. Capital is an equity account, so it is also credit balance. Wages expense is a form of expense, so debit balance. Next we have loan, which is a form of liability, credit balance. Accounts receivable is a form of asset, debit balance. Provision for warranty, it is a form of liability. It represents a present obligation to repair products, so credit. Income tax expense is a form of expense, debit. Income tax payable is a form of liability, credit. Land is a form of asset, debit. Interest revenue is a form of income, credit. Alright, after you know the basic of debit and credit, we can look at general journal. Your debit and credit for each transaction or event is first recorded in journal, which is the book of origin entry. We will record the transactions chronologically, meaning according to the date, in order to keep your entry tidy. And these entries are important before you can do the posting to ledger accounts in step 3. Okay, and what are the benefits of recording the transactions in general journal? It can help us to show the complete record, it make it easier to trace the transaction, and it also make it easier to detect error. And the following shows the format for the general journal. First of all, we have the date column, we must record the date. And in the particular column, we will record the ledger account name. So, which one you debit and which one you credit. And we also need to provide a little narration. So narration is just a brief summary in terms of what you are recording. It needs to be concise. And what is post-reference? Post-reference means account number. Just imagine that each of us has our own student ID and staff ID. So every account also has their own ID. And note that in this topic, we only focus on general journal. Meaning in today's topic, we record everything in general journal. They are specialized journals. Examples of specialized journals include cash journals, purchase journals, cash payment journals, and cash receipt journals. We will look at special journals in topic 4. Alright, let's go through an example. On 11 June, we receive interest. So on June 11, we need to debit cash at bank because we receive interest, cash interest, and we will also credit interest revenue, which is a form of income, $2,000. And we provide a little narration here. Okay, and as mentioned, what is post-reference? Post-reference is the ID, is the number of the account. And how do we get all this account number? Account number is based on chart of accounts, and we will look at chart of accounts later. Then look at the second transaction. On 21st June, we paid this month's insurance. So insurance is a form of expense. To increase expense, we debit expense. So debit insurance expense. And because we paid with cash, our asset reduced. To reduce our asset, we need to credit cash at bank. So debit insurance expense, credit cash at bank, $300. Next, we purchase office desk of $1,000 on credit. When we purchase office desk, this is a form of asset. Our office furniture, our asset will increase. To increase our asset, we debit. So we debit office furniture, $1,000. And how do we purchase it? On credit. When we purchase something on credit, we have a liability. When liability increase, we need to credit them. Therefore, we credit accounts payable, $1,000. Alright, student task. So prepare the journal entries for these transactions, and we will discuss in a while. So let's assume that you have actually attempted the questions. On 1st of December, P. Dodo contributes 100K to commence business. So when you contribute cash to the business, you debit cash at bank, asset increase, and you will credit capital. Because capital contribution is a form of owner's equity, this will increase equity. To increase equity, we need to credit. Then, look at the next transaction. 2nd December, there is a credit purchase of inventory from UOptis, 26.4K. When you purchase inventory on credit, you will debit inventory, because inventory is a form of asset. When asset increase, you debit it, 26.4K. But at the same time, because you purchase the inventory on credit, you have a liability. To increase liability, you will credit it. So you credit accounts payable 26.4K. Then, look at the next transaction. 5th of December, there is a credit sales of $40,000 to V Telstra, N/30. N/30 means credit term. The credit term is of 30 days. The account must be settled within 30 days. So when you sell the item to the clients, you have to actually debit accounts receivable because you're actually selling it on credit. Okay? So you debit accounts receivable, means asset, and then you credit sales revenue, which is a form of income. Then, on 5th of December, we also need to record the cost of goods sold because we sell the inventory. And cost of goods sold is a form of expense. To increase expense, to recognize expense, we debit cost of goods sold, 25.6K. Okay? And credit inventory, because when we sell inventory, the amount of our inventory will reduce. So we credit inventory to reduce the asset, 25.6K. And note that there are two ways to account for inventory: perpetual method versus periodic method. In this example, we use the perpetual method because we record the cost of goods sold continuously. We will cover inventory in greater details in later weeks. And on 10 December, there is a cash purchase of inventory, $40,000. When we purchase inventory, we have to debit inventory $40,000, but because we purchase it using cash, cash as another form of asset declines, so we credit cash at bank $40,000. And on 15 December, we pay UOptis. And who is UOptis? UOptis is our supplier or creditor, $20,000. When we pay our supplier, we reduce our obligation, we reduce our liability. To reduce liability, we will have to debit. So we debit accounts payable $20,000 and we credit cash at bank $20,000 because we pay with cash, it will reduce our asset. So we credit. On 18 December, we collect money from our customers, V Telstra, from our debtors. So when we receive money from our customers, we debit cash at bank because asset increase. At the same time, another form of asset actually decrease, which is accounts receivable. So we need to credit accounts receivable 38.4K. And in the next question, we actually pay rent to the landlord, 11.6K. And rental expense is a form of expense, so we debit rent expense 11.6K. And because we pay with cash, cash declines, asset declines, we credit cash at bank 11.6K. On 21st of December, so repairs are completed by electrician and we paid $12,000 for that. Repairs and maintenance is a form of expense, so we debit repairs and maintenance expense $12,000 because we pay with cash, asset decline, credit cash at bank $12,000. Alright, on 21st of December, we paid wages to employees. Wages and salaries again is a form of expense, so debit wages and salaries expense 5.8K and we credit cash at bank 5.8K. And on 31st of December, let's assume that we have income tax, okay, and we have to pay this income tax payable. So we debit income tax expense. Okay, sorry. On 31st of December, we estimate that we have income tax expense of 1.4K, okay? And income tax is a form of expense. So to increase expense, we debit income tax expense 1.4k. In this case, we have not paid for the income tax. Because we have not paid for the income tax, we have a liability. To recognize liability, we credit income tax payable 1.4k. Alright. And the little note actually reminds us that for every entry, there must always be one debit and one credit at least in order for accounting equation to be balanced. And we should actually record those journal entries in chronological order. So means, according to the date and to the right sequence. Otherwise, our entries will be very messy. And we need to provide a little narration, a very concise, a very brief explanation to every entry that we make. So what is next? We are now in step 3. Based on journal entries, we will do posting. Posting means we transfer the amounts recorded in the journal to proper ledger accounts. General ledger accounts means individual accounts maintained by the company, which can allow for the preparation of financial statement. Every ledger account will accumulate transactions affecting the same accounts. For example, you will record all cash inflows and cash outflows in the cash account. A ledger account takes 2 formats. Okay, the T account format and the running balance format. In this topic, we focus on the T account format. So that's how the T account format looks like. So you only have 2 columns, one debit column and one credit column. Okay, and again, because asset and expense are at the left hand side of the equation, so they have normal debit balance. To increase them with debit, to decrease them with credit. On the other hand, liability, income and equity is at the right hand side of the equation. They have normal credit balance. To increase them, we have to credit, but to decrease them, we have to debit. Alright, based on general journal, every line item, meaning every entry, is posted to a ledger account. And each account provides a record of increases and decreases of the transaction. So the balance figure can be quickly determined at any point in time. In real life, the computer would do the posting for us. And we will see this when we do the assignment or the learning task using Xero. But every accountant still needs to learn how to do this manually, because it is a very basic practice for every accountant. So how do we know about the ID? How do we find the ID of the account or the post references for each account? We can look at the chart of accounts. Chart of accounts systematically lists all accounts maintained by the company and the number for each account. And in balance sheet and income statement, companies usually list the account by the same order. The idea is to allow us to quickly detect the account and speed up the process when we prepare financial statements. Okay, and we will record the ledger account number or the ID in the post reference column of the general journal. This slide shows an example for chart of accounts. Here you have assets. Asset accounts take the number ranging from 100 to 199. It is further split into current and non-current assets, and the same applies to liabilities. And we also have the ID assigned to owners' equity accounts, revenues accounts, and expenses accounts. So each account has their own ID. So based on this example, let's do the posting by using the T account format. So on June 11, we receive interest. When we receive interest, we debit cash and credit interest revenue of $2,000. At the left-hand side of cash at bank account, we will state interest revenue as the particular. and we debit $2,000. And remember that we must always provide the date as well. Okay. So this is called cross-referencing. You always write the opposite account's name when you prepare the posting. Then, at the right hand side of the interest revenue account, we will credit $2,000 and we will write the same date, 11th of June. Okay. But here, as a cross-referencing, we need to put cash at bank, the opposite account's name. So can you see that how we do the posting? And in this example, we know that the cash at bank number is 100 and the interest revenue account number is 410 and the insurance account number is 540. Then on 21st of June, we paid this month's insurance. So we debit insurance expense because expense is at the left hand side of accounting equation. To increase expense, we debit. Okay, so 21st of June, we debit $300. But what is the cross-referencing here? The cross-referencing will be cash at bank, the opposite account name, because we debit insurance expense, credit cash at bank. And we go to cash at bank account, the right hand side of it, we will do the same thing. We will credit $300 on 21st of June, but we actually wrote, we will actually write insurance expense as the particular. Note that because cash at bank account is an asset account, and we know that we report asset, liability, and equity on balance sheet. So there will be opening balance and closing balance for cash at bank account, for asset account. So in order to determine the closing balance, we need to sum the total figures here. And we find that in this case, the left hand side, the debit side has a higher figure, which is $2,000. Okay, and the credit side, we only have $300. So in order to bring $300 to $2,000, we need to have $1,700. So 1,700 is actually the closing balance. Alright. So on 30th June, on the reporting date, we have closing balance 1.7k. And then on the next day, 1st of July, we will bring it to the debit side of the cash at bank account. So the closing balance and the opening balance is always written at the opposite side. Okay. And this makes sense because we know that cash at bank is actually a form of asset, and asset actually has a normal debit balance. So the opening balance of the asset must always at the debit side, and the closing balance will be the opposite. Okay. But note that for interest revenue and insurance expense account, we do not calculate the opening balance and the closing balance because those two accounts will be close to profit and loss summary account at the end of the period. So the balances are reset to 0 at the start of next period. We will cover closing entries in the next topic. Because of this reason, we do not need to calculate the opening and closing balance for interest revenue and insurance account because expense and revenue are temporary accounts. They are not permanent accounts. They are not reported on the balance sheet, only in the income statement. So we don't calculate opening and closing balance. On the other hand, asset, liability, and equity accounts, because they are permanent accounts, they are carried forward from one period to another. We need to calculate the opening and closing balance. Then, on 28th, we purchase a desk, we purchase an office furniture on credit. So we debit office furniture, $1,000, and we do the cross-referencing. The opposite account's name is accounts payable on 28th of June. Okay. Then we credit accounts payable, $1,000, and we do the cross-referencing office furniture. And again, because office furniture is actually an asset account, So we need to determine the closing and opening balance. So the closing balance is $1,000 and we bring it to the next period. So office furniture asset has a balance of $1,000 at the left hand side, at the debit side. So this is the normal balance. Do we need to close accounts payable? The answer is yes, because accounts payable is a form of liability. So when we close it, we debit with a closing balance $1,000. So now the accounts is actually balanced, but then we will carry forward the closing balance as opening balance to the next period. So it will appear at the credit side of accounts payable, because accounts payable is a form of liability, and liability has a normal balance at the right hand side, at the credit side of the account. Alright, your next student task. So based on the previous student task, the PDodo example and the following chart of accounts, please do the posting for the 11 transactions. Alright, so let's assume that you have done the posting. Please check your answer. So this slide shows the solutions for the cash at bank account and the capital account. Cash at bank account and capital account, because one is asset, one is owner's equity, you need to also determine their opening balance and closing balance. And of course, for cash at bank, the normal balance will be at the left hand side, at the debit side. Whereas for the capital account, the equity account, the normal balance will be at the right hand side, the credit side. Alright, please check whether you have also correctly posted the transactions to the inventory account, accounts payable, and accounts receivable account. And again, because inventory is an asset, accounts payable is a liability, and accounts receivable is an asset, you need to determine the closing balance and opening balance for those accounts. So inventory as an asset will have a normal debit balance. Accounts payable as a liability will have a normal credit balance. Accounts receivable as a form of asset will have a normal debit balance. And the next slide shows the solutions for sales revenue account, cost of goods sold account, rent expense, repairs and maintenance expense, wages expense, income tax expense, and income tax payable. Okay. So for revenues and expenses, because you don't have opening and closing balance, we do not have to close them. We do not have to determine the closing balance or opening balance, but we will close them to P&L summary, profit and loss summary account when we talk about closing entries in the next topic. But note that the account income tax payable account is a liability account. So for this account, you should also calculate the opening balance and closing balance. Okay, so in this case, because it remains unpaid, the opening balance in the next period for income tax payable will also be 1.4K. Okay, now we are in step 4, try balance. Try balance lists all ledger accounts with their respective debit or credit balances. And why do we need try balance? Try balance is to verify the equality of debits and credits posted to the ledger account. But it does not ensure that the balance of those accounts are correct and all journals have been posted or correctly posted. But why do we still perform try balance? If the try balance is balanced, at least there is a chance that our balance sheet will be balanced. But if our try balance is not balanced, there is no way that our balance sheet will be balanced. Okay, another student task. Based on the ledger accounts in the previous student task, complete the following try balance. So let's assume that you have attempted this question. Now this is an example of try balance. It has 3 columns, one column for the account name, one column for the debit figures, and another one for the credit figures. You need to key in the closing balance for each account and get the total. So in here we have bank 49k debit, accounts receivable 1.6k, inventory 40.8k, okay, and accounts payable credit 6.4k, income tax payable 1.4k, capital credit 100k, sales revenue, income, okay, it is a form of income, so we put it at the credit side, 40k, cost of goods sold, which is a form of expense, so we put it at the debit side, 25.6k, rent expense 11.6, repairs and maintenance expense 12k, wages expense 5.8, income tax expense 1.4. So when you sum up the debit and credit, you should get 147,800. So your total debit equals to your total credit. So what if your trial balance is not balanced? In fact, there are many possibilities. First, there can be due to additions error. So re-add your trial balance. Maybe you entered the wrong figure in the calculator. Second, you need to check whether you have posted the correct amount to the correct side of the ledger account. Third, check your journal entry. Does the debit figure equal to the credit figure? And fourth, you need to check if you have calculated the balance for each account correctly. Next, what is the difference between the balance? Maybe you have missed one of the postings. Next, you can also look at the difference. If the difference can be fully divided by 2, one of the entries may be entered into the wrong side. For example, there are 2 debit or 2 credit rather than 1 debit and 1 credit. Next, there is another possibility. If the difference can be fully divided by 9, it actually indicates 2 possible errors. The transposition error. The transposition error means the order of the digit is altered. For example, 4610, but you record that as 4160. So if you take the difference between 4610 and 4160, you get 450. If you divide 450 divided by 9, it can be fully divided. So this is an example of transposition error. And what about the slight error? The slight error means the decimal point shifted to the left or to the right. Let's say 4610, you record it as 461. So if you take 4610 minus 461, you get 4149. And if you divide 4149 by 9, it can be fully divided. Alright, so if the difference can be fully divided by 9, it indicates either the transposition error or the slight error. And what if your trial balance is balanced? Now, if your trial balance is balanced, it may mean that everything is correct, but there is no guarantee. Okay, there is no guarantee. Why? Because you may have missed one transaction. If you miss one transaction, you do not record debit and credit, so it will still be balanced. The second example, your debit and credit figures are correct, but they are both recorded in the wrong accounts. And the third example, you may have recorded the same transactions more than once. For example, 2 same amount of debits and 2 same amount of credits, so they will still be balanced. And the fourth example, you posted the right debit figure to the debit side, but in a wrong account. For example, you should post to the debit side of cash, but you posted to the debit side of accounts receivable. In this case, your trial balance will still be balanced. Next, the figures calculated are incorrect, although they are posted to both sides correctly. And finally, there may be some offsetting mathematical error in the accounts. Alright, so please go through these questions and we will discuss at the beginning of the next topic.